Hi, this is John Zolitis. I'm going to give you a presentation that was originally presented at ValueX Vail, which is a conference for value investors in Vail, Colorado. The audience for this talk was professional investors, but I believe it should be accessible to individual investors as well. Before we get started, just mention this video is not an advertisement. Corvatus Capital is a registered investment advisor in the state of New York, and please consult your advisor for advice which is tailored to your investment needs. What's the question that investors are trying to answer? What are we trying to solve? We know that stocks can really only go up in one of two reasons. One is because the company's cash flow and earnings increase, or simplistically, because investors are willing to pay more for that same cash flow and earnings stream. So why is this so hard? Today's talk isn't going to be about security analysis and how to go through companies, but rather the things that we do as investors that make the simple task of forecasting cash flow and earnings and trying to judge what people will pay for these in the future more difficult. And the contention that I have, or the angle that we're going to pursue, is by talking about something called mental models. What's a mental model? Well, we'll start with the Charlie Munger definition here, which is about facts hanging together on a lattice work of theory. But if you find that slightly too obtuse, here's a more simplistic definition of mental models, which I like, which shows that it's a specific thought process that you use to examine a problem. And the idea is that this simplifies the task. But my contention is that in this simplification, sometimes things go poorly. Why do they go poorly? One of the factors is that we are just overwhelmed with data and information, and simultaneously, there's a desire to process it quite quickly. Secondly, there are industry structures, especially incentive-oriented, that prevent us from acting in our own best interests. And then lastly, there's the effect of our own nature together with the media and social factors, which influence us to make poor decisions at the wrong times. Using a book by Peter Senge, he talks about mental models not being the problem, they're simplifications, but rather the issue is that when they become implicit, that is, that we start being aware that we're using them. And I think that happens to a lot of us from an investment standpoint. So when we talk about the models, I'm going to go through 7, and then we'll talk about what they might mean. So before we get started, though, I'm going to ask you to go along with me on this little mini quiz. So first of all, how many days does it take for the moon to go around the Earth? It's about 27. How many days does it take for Mars to go around the sun? The answer is 687. How about Venus? 225 days. How many days for the Earth to go around? 365. What do these numbers have in common? See if you can answer it. What they can have in common is that none of them represent the ideal time frame from which to evaluate investment returns. They're all just arbitrary numbers. So my contention is from the first mental model I want to mention is a constant reference to year-to-date performance or one-year performance. 365 days doesn't correlate with the economic cycle or the business cycle. So when you make your investment decisions with this framework in mind, this mental model, I believe you're prone to make investment errors. Rather, you should probably consider each investment on a time horizon which is appropriate to that specific investment. The second model I'm going to talk about is the wise man problem, or at least that's what I call it. And in my view, this is an issue that happens when you actually have a lot of experience, but your experience actually gets in the way of seeing things that are new and different. And rather than approach current conditions and understand what's unique or different about them, instead, you think just about what you've seen in the past. And in fact, I would say that 2023 is a very good example of this, as especially economists have forecasted recession based on the inverted yield curve, rising interest rates. And of course, they have, as we know, as at this point, they've all been completely wrong. Similarly, something I call analysis by analogy, I think creates error. This is a little bit more related to what equity analysts do. And so in this case, when you look at a company for the first time, I believe that frequently the first order of business is to compare it to companies that you believe you already know. But in fact, this helps you to gloss over what might be different or special about the new company you're analyzing. And in a desire to understand the company or the business quickly, I think you're likely to or prone to miss important factors about that new company, leading to investment error. So both the wise man problem and analysis by analogy, and the next one I'm going to talk about, reflect something called the pattern-seeking brain, which might also be called the lizard brain, combined with the idea that you need to move quickly. And I think both of these get in the way of recognizing things that are new and different. Furthermore, another thing that happens quite frequently is that stock prices get confused for information-bearing vehicles. So I think you should ask yourself how many times you looked at a chart or you bought a stock that started to go down and you asked yourself what the stock was telling you that you didn't already know. In fact, in many cases, especially with a long-term orientation in mind, there's no information whatsoever in the short-term movement of stock prices, but your brain is actually just programmed to try to find information, or find rather a narrative to explain that, which I think creates a source of investment error when you act on that narrative. My fifth idea is something I would call conflating uncertainty. Now, this idea is a little bit more difficult to grasp. And my contention is that the quantity of uncertainty in the future is constant, that it does not change. Whereas when we typically think about uncertainty, we view it through the lens of the uncertainty in the present conditions. As an investor, you must always accept uncertainty in the future, and you cannot have better visibility or lower visibility based on present conditions, because what creates uncertainty is not the things that we know today, but the unknown unknowns. This is a bit of a difficult idea to get across, but I think more simplistically, it might be possible to understand that people are fooling themselves when they believe they have high visibility. And the corollary is that when they think uncertainty is very high, you typically get stock prices at a discount. So making investment decisions on perceived change and uncertainty in the future, I believe, sets up investment error. Lastly, I'll talk about, I have two more. This first, number 6, is the news junkie. And I think this is something that happens to investors. You think you need to know everything about what's happening out there and also everything about a company. In fact, I believe that this is very counterproductive way to approach the problem of investing. You can't know everything. And if you were to spend that much time analyzing company, you'd actually be wasting your time because you learn too much information, which is not particularly relevant to the outcome of the business. So rather than trying to reach for a all-encompassing knowledge of the markets or a particular business or industry, I think it's better to accept uncertainty and focus on the things that you can reliably know. And otherwise, I believe that you will be prone to error if instead you spend too much time focusing on things which are not which are just incremental and not particularly material to the overall business. Lastly, number 7, I'm going to kind of fight with a well-known principle of value investors as emphasized or articulated by this quote by Seth Klarman in his book, Margin of Error. And he basically says that you can't get a value investment in a popular security. These securities are never attractive. You must be searching for in these kind of lost, unknown corners. I just don't think that's the case. I think large, well-followed companies can frequently be mispriced, and it's our job as investors to recognize that. It doesn't matter if the security is unknown or out of favor. In some of those cases, you may find things that are very undervalued and interesting, but you also may find a lot of really terrible companies. So I just don't think that that's the framework or the mental model you should use when you're trying to approach which stocks you want to buy. How are we going to get out of this? Just summarizing here, when you're an investor, you're not operating in a safe space free from outside influence. You can't pause time and look at all the interesting things that come your way. And you cannot separate yourself from behavioral or evolutionary driven forces or social influences. We use mental models to help us process information and allocate limited resources, but occasionally or oftentimes these models work against us due to factors outside our control. I talked about some of the models I think do not help us, in particular, one-year investment horizons, the wise man problem, or analysis by analogy, or trying to find signal in noise, all of which are functions of the pattern-seeking brain trying to absolve us of finding what's interesting and new or different, or fooling us about narratives of information, which is just not really there. Fourthly, around uncertainty, I think we fool ourselves around our ability to see into the future. Sometimes we think we have visibility, sometimes we think we don't. I think visibility is always about the same, which is to say not very great. And that means that we need an investment strategy that accepts that rather than is based on hopes and dreams, which are not the case. I also mentioned that I shouldn't bother consuming all kinds of information, and no points for creativity. Lastly, just some thoughts here. Investment opportunity, I think, can occur when change is unrecognized and the pattern-seeking brain is trying to save you and others by glossing over important differences that are occurring. So I think you should be looking for those differences rather than seeking the patterns. And from a market standpoint, I think opportunities can occur when investors focus on present conditions and conflate uncertainty that they see in things that are happening today with an uncertain future. That typically correlates with stocks at a low price and an opportunity. So I hope you've liked this talk. Please leave some comments in the below, subscribe if you like, and feel free to check out my website if you'd like some more information about what we're doing or to see some of our presentations on specific stock ideas. Thanks a lot.